This is Nightly Business Report with Bill Griffith and Sue Herrera.
Lingering effects. 10 years after the financial crisis, investors haven't completely gotten past those dark days, and it's evident in the market psychology today.
Gaining strength, Hurricane Florence is making a beeline toward the East Coast, and in its path is a concentration of power plants.
Wall Street remembers a firm that lost so much 17 years ago, spent this day and every 9/11 giving back. Those stories and more tonight on Nightly Business Report for Tuesday, September 11th. Good evening, everyone, and welcome back. It's so great to have you back.
I took an extra long vacation. We had friends who got married in Germany, so we had a lovely time over there for the last week or so.
Well, you were very much missed.
Thank you. It's great to be back. Let's get to our news tonight. Here we begin with the stock market, which registered gains as technology stocks rebounded and the energy sector rallied today ahead of Hurricane Florence. Trade concerns were put on the back burner, at least for now. And so investors bought up stocks today. The Dow gained 113 points to 25,971, with Apple leading the way. The Nasdaq was up by 48. The S&P 500 added 10. And while today's trading was nothing extraordinary, what investors witnessed 10 years ago this week was, and it changed the way Americans think about their money. Bob Pisani has more for us tonight.
A decade since the financial crisis has taught investors on Wall Street some key lessons, but it's also changed how investors think. Here's 5 personal takeaways from the crisis and how it changed the conventional trading wisdom. First, investors do not act rationally in a crisis. They don't buy low and sell high. They do the opposite. They buy high and they sell low. In the week of March 6, 2009, I'll give you an example. The S&P hit 666. That's a drop of more than 50% off the historic high. It made no sense at all to sell with the market down 50%. But that's exactly what happened. Outflows from mutual funds accelerated at the end of 2008 into 2009. It didn't turn positive until later in 2009. Ouch. Second, there isn't always a right price. When the mortgage-backed securities market fell apart, no one could agree on how to price the derivatives that were at the heart of the crisis. The market seized up, and that affected other credit markets. Third, increasing complexity does not decrease risk. It increases risk. Everyone thought you could slice and dice these mortgage products into manageable tranches, that's what we call them, that would spread the risk out. And that proved to be terribly wrong. Fourth, the markets are not as efficient as everyone assumes. Now, I know this is a key tenet, modern portfolio theory and all that, but Wall Street had very poor visibility on this. Corporations were seeing business deteriorate on an almost daily basis, and poor communication and data sharing from the companies themselves really exacerbated the problem. Many companies provided very little, if any, guidance and shared as little information as possible. We were going in the dark. Finally, bold, swift action works better than slow, indecisive action or no action at all. The Fed stepped in to make sure banks would not fail ultimately, and that finally stopped the free fall. You know, in a sense, John Maynard Keynes, the famous economist, he won. Governments around the world stepped in, they propped up critical institutions, and they spent an awful lot of money. Keynes' interventionist ideas won out in the intervening years as well. Global central banks in Europe and Japan began buying up assets, and governments ran big deficits. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
The aftermath of the financial crisis has been the longest bull run for stocks in U.S. history. But today, the founder of the world's largest hedge fund said that he's telling investors to be less aggressive and more defensive.
Right now, we have just gotten to the point in my judgment that it's more than the risk return is more negative. I would then be in a more defensive posture. Whatever your strategic asset allocation issue is, you know what your strategic mix is. Right. I would be less aggressive rather than more aggressive.
When it comes to the economy, Dalio says that he thinks the economic current cycle in the 7th inning, that's where he thinks it is, and he is urging the Federal Reserve not to get ahead of the market as it continues to hike interest rates.
Meanwhile, the budget deficit is widening. According to a new report from the Congressional Budget Office, it hit nearly $900 billion over the first 11 months of this fiscal year. That is an increase of more than 30% over the same period last year. The nonpartisan CBO said that the tax law and the agreement to increase government spending contributed to the widening deficit. Revenue rose 1%, while spending was up by 7%.
Those tax cuts are contributing to record optimism among small business owners. According to the National Federation of Independent Business, companies are planning to spend more on capital investments, and hiring expectations are at an all-time high. A separate report from the Labor Department shows 6.9 million job openings in July. That's the most ever. The number of workers confident enough to quit their jobs also hit a record.
Canada's foreign minister returned to Washington today to continue those difficult renegotiations of the North American Free Trade Agreement. And Chrystia Freeland said today the discussions have been constructive and productive, but there's still more work to be done.
It is a truism of trade negotiations that nothing is done until everything is done. We have been working extremely intensively over the past 2 weeks, and as I said to you on Friday, we really feel both sides that we're in a kind of continuous negotiation phase.
U.S. officials would like a new agreement to be in place by October 1st.
China now plans to ask the World Trade Organization for permission to sanction the U.S. The world's second largest economy is citing what it calls Washington's non-compliance with a ruling in a dispute over U.S. dumping duties. Experts say the fight could drag on for years, and it comes as tensions continue to escalate. Last week, President Trump said he was, quote, ready to go on tariffs on another $200 billion on Chinese goods.
Meanwhile, China and Russia appear to be strengthening their own economic ties. The leaders of those two countries have been meeting at the Eastern Economic Forum, and that's where we find Jeff Cutmore for us tonight.
A relationship built on trust is how Russian President Putin welcomed his counterpart Xi Jinping to the Eastern Economic Forum here in the far eastern city of Vladivostok. The two leaders clearly using this photo call opportunity to express their desire for deeper diplomatic, political and economic ties. In a number of comments made by President Xi, there were digs at US President Trump over current trade policy and his unilateral approach to international organizations. On both of these issues, Xi Jinping said it was important to have the support of Russia. Trade and economics never very far away at these major events, and some $100 billion worth of deals have been inked related to the technology sector. One specifically stands out, and that is Alibaba signing a deal with Russian partners here to provide an enhanced social commerce platform.
600 million customers that some of the Russian businesses can supply products to. Mail.ru, which is our partner in this deal, has 100 million Russians who will get more Alibaba products.
A number of Russian business leaders that we've spoken to here at this event say that the increased pressure from sanctions is making operational decision-making harder, and they are concerned that there may be further sanctions coming down the pipe from Washington. As a consequence of those, they point out that they are increasingly having to look to the east to do business, and that probably means more deals as far as China is concerned. This is Jeff Cutmore for Nightly Business Report from Vladivostok.
And now time to take a look at some of today's upgrades and downgrades. We begin with Tesla tonight. It was downgraded to neutral from buy at Nomura Instinet. That analyst who had been one of Wall Street's biggest bulls on the stock now calls Tesla uninvestable, in part because of CEO Elon Musk's erratic behavior.
The risk is that if this behavior continues and he continues to be under a lot of scrutiny, the Tesla brand starts to erode. And if the Tesla brand starts to erode, then I think that could spell real trouble, because for people who are not necessarily in the weeds, they may have second thoughts about buying a Tesla vehicle if they feel like the company's not going to be around long term.
Shaw's price target was dropped from $400 to $300 a share. That stock fell 2% today to $279.44. CBS also saw its rating cut to neutral from buy at UBS. The analyst there says that uncertainty around management changes will limit any move higher in that stock. Yesterday, of course, we told you about the departure of longtime CEO Les Moonves amid sexual harassment allegations. Price target of CBS now is $60. The stock rose a fraction to $55.40 today.
Nike was upgraded to buy from hold at Canaccord Genuity. The analyst says Nike has regained its footing and expects long-term gross margin gains. The price target, $95. The stock rose a fraction to $82.63. Snap was upgraded to outperform from neutral over at Wedbush. The analyst cites recent management changes and improved execution. The price target is $12.25. The stock rose 1.5% to $9.89.
Still ahead, will Hurricane Florence be the most costly ever to hit the U.S.?
The Trump administration is reportedly ready to ease some environmental rules. According to numerous reports, the EPA will ease requirements for oil and gas companies when it comes to releasing methane into the air. The proposed changes would give drillers a year to do leak inspections instead of 6 months and 60 days to make repairs instead of 30.
Well, Hurricane Florence is still days away from making landfall, but already there are early estimates as to what it might cost. CoreLogic says it could be one of the most expensive storms ever to hit the U.S., could cost more than $170 billion and damage about 750,000 homes and businesses. Jackie DeAngelis is in the storm's path for us tonight. She's in Wilmington, North Carolina.
Hurricane Florence is turning into a threat unlike any other.
The waves and the wind this storm may bring is nothing like you've ever seen. Even if you've ridden out storms before, this one is different. Don't bet your life on riding out a monster. If you wait until conditions get bad, it may be too late.
The bullseye point, Wilmington, North Carolina. And in the storm's path, a concentration of power plants, including more than a half dozen nuclear ones, which supply about a third of the power to North Carolina and more than half to South Carolina. Duke Energy is warning that the storm could exceed the damage from Hurricane Matthew, which submerged North Carolina towns in 2016. The company also said it could take weeks to restore power to some of the hardest hit areas. Dominion Energy urging its customers to prepare as well.
Gasoline demand certainly outstripping supply right now, but more is on the way, and those who need it to evacuate will likely be able to get it. Meantime, no major refineries here, but the bad weather could certainly impair shipments of gasoline up the East Coast. The residents who are getting ready to leave are making those preparations.
And we're probably going to have to start over, along with a lot of other families. And then the ones that are going to be trapped here that can't get off. I know like 7 families that don't even have a car to get off.
Tell me about that.
And they're just going to board up their windows and pray for the best.
State and local authorities repeating, safety first. Lives are more important than things.
Those citizens that need to evacuate, we implore that you evacuate now. You heed your local and state warnings and do your part in our team to help us save lives. We can rebuild infrastructure, we can rebuild homes, we cannot replace lives.
With days to go, the mood is tense on the ground, and the fear is this may be the worst storm this state has seen in more than 60 years. For Nightly Business Report, I'm Jackie DeAngelis, Wilmington, North Carolina.
Yum China may have lost a potential buyer, and that's where we begin tonight's market focus. Bloomberg says a group of Chinese investors will walk away from their attempt to buy Yum China after their initial bid was turned down. The investor group, which includes Hillhouse Capital and KKR, were also said to be concerned with softness in Yum's financial performance. Yum China shares plunged 13% to $31.94. Boeing ramped up deliveries of its top-selling 737 airliner last month after hitting a lull in July. The aircraft maker delivered 48 jets in August, and that is up from 29 the prior month. Production bottlenecks are causing a growing number of Boeing planes to sit unfinished, and that's resulting in delivery delays. Boeing shares were up about 1% to $345.25. And the FCC says it needs some more time to review the proposed merger between telecom companies Sprint and T-Mobile. The agency said it is pausing the 180-day informal transaction timeline so that a third party can review that deal. Shares of Sprint rose 0.5% to $6.08, and T-Mobile shares finished up a fraction to $65.91.
Payment technology company USA Technologies says it would miss its filing that is required, the 10-K form, with the SEC by Thursday's deadline. The company says it is launching an internal investigation to its accounting practices and its financial reporting systems. Shares cratered as a result. They fell nearly 40% today to $9.20. Then after the bell tonight, Gilead Sciences said its experimental rheumatoid arthritis treatment developed with drug maker Galapagos performed well during a study. Shares of Gilead initially rose in after hours, but finished the regular session today down a fraction to $72.23. Meanwhile, shares of Galapagos were flat in the extended session, finished the regular session up 5% to $102.74.
A decade ago, when we were in the throes of the worst housing crash in history, large-scale institutional investors went on a buying spree, snatching up foreclosed properties and turning them into rentals. Most expected this to be a short-term play, and that once home values recovered, they would sell at a nice profit and call it a day. But that is not what happened. Diana Olick explains.
In the suburbs of Dallas, the single-family rental business is thriving, and so is a new class of companies. Blackstone's Invitation Homes began buying properties barely 6 years ago and now boasts a portfolio of more than 80,000 homes and close to 1,300 employees.
I think it's a natural evolution in the space, much like the apartment industry in the early 80s. If you look at where we're at today in single-family rentals, it's still very early innings in terms of what this space could be.
The space was much more crowded at the start. Big names like Colony, Starwood, American Homes for Rent, and Invitation Homes bought tens of thousands of properties, but they found it hard to manage so many on a large scale. They consolidated, and today just American Homes and Invitation remain.
One of the barriers to entry is just having the people's processes and systems in place that allow you to create an efficient business model. That took some time to develop and get right.
Initially, that's why most didn't think the business would last.
Most people did believe that this asset class was more of a trade versus a viable business. And I'd put us in the surprised camp as well.
It's much easier, after all, to manage a multi-unit apartment building in one tall space than thousands of properties across multiple markets. But technology and consolidation helped, and now both Invitation and American Homes for Rent have about 96% occupancy and are turning big profits.
2016 was a huge turnaround year for these companies, where operating performance, both occupancy, rental rate, and operating margins all began clicking and proved to investors that these companies could operate this asset class more like an apartment company.
With home construction still anemic and a critical shortage of affordable homes for sale, demand for rental housing is unlikely to wane. And some argue that having management on a corporate scale with all its new technologies makes renting even more attractive, especially to millennials, meaning this new class of rentals could change the housing landscape of supply and demand for the foreseeable future. For Nightly Business Report, I'm Diana Olick in Washington.
Let's turn to Fred Glick now to talk more about the state of the housing market. He is the CEO of the real estate and mortgage brokerage company Arriva.com out in California. Fred, good to see you. Welcome back tonight.
Hi, Bill. Hey, thanks for having me.
So we have far more renters today than we did a decade ago. Is that good or bad for the real estate market, and how long do you expect that to continue?
Well, it's actually, I'll say, good. And why I say that is because hopefully people will be saving up and eventually buying or finally consider buying in a few years from now. Because right now, people's mentality is not what it used to be, where everyone said, I have to own a house. That's the American dream.
Right.
It's just not that way anymore.
What about the housing market in general? We've gone through this very difficult time. The banks have tightened up their lending requirements. That would seem to be a good thing. Do you feel good about the market as it stands now?
Yes, Sue. The story is that, yes, it is difficult, quote unquote, to get a mortgage compared to it was in 2008, when as long as you can breathe and sign your name, you got a loan. Now there's restrictions on how much income you need to qualify for a mortgage, which is a good thing. And they don't allow any mortgages where you can't tell them what your income is for an owner-occupied property. So that's much better.
The dearth of houses that are being built, do you expect that to change? I mean, why aren't builders building more if the demand is so high these days?
Number one I'll put is local regulations. I have a great story of my friends who live in Malibu. It took them 16 years to get into the house after they bought a piece of land and wanted to build. So that has to change. There's got to be more programs for people to be able to buy their own new construction property, their land, and do new construction on them. And it's just supply and demand. They just can't get it out quick enough. But what they do get out is too expensive for the average person.
Right.
And that's the biggest problem here in the Bay Area.
Yeah, well, I'm sure in your neck of the woods it is. What about interest rates? I mean, that's kind of one of the side stories to housing. One, there isn't enough housing out there, but two, we're seeing interest rates go up. Does that also take people out of the market for a home?
Not at all. I don't think so.
Really?
There's maybe a couple of people who just said, oh my God, rates went up. If you remember, the low in this last cycle was about 3 3/8 on a 30-year fixed. Now, I think I quoted one a couple of days ago at around 4 1/8. So it's not that much worse. And plus, you can take a 10, a 7, or a 5-year ARM. So you have a fixed rate for a long period of time. It's something you can qualify for. Plus, you take stuff in Silicon Valley when there's 12 people trying to buy a house. They don't care what the rate is. They just want to get the house. So I'm not that concerned about interest rates, even long term, because if you remember 20 years ago, the Chinese government figured out that they're going to buy mortgage-backed securities to keep our rates low so people will buy the stuff to put in their houses. So we're always going to have that.
We will. Fred, always good to see you. Thank you for joining us tonight.
Same here, Bill. Thanks.
Fred Glick with Arriva.com.
Coming up, a day of terror and heartbreak has turned into a day of remembrance and giving back.
Yes, on this day every year, Cantor Fitzgerald holds its annual Charity Day. It is a day to remember the firm's employees who lost their lives during the 9/11 terror attacks. It's also a way to turn tragedy into something positive by giving back. And as always, celebrities were on hand to help out. Leslie Picker is in New York for us tonight.
Ryan, this is going to be the luckiest day of your life.
Imagine placing a trade with Alec Baldwin.
We can buy 150,000.
Or Goldie Hawn.
Buy low, sell high. I listen to Warren Buffett.
Or Gene Simmons. That's what happens on the trading floor of Cantor Fitzgerald on each anniversary of 9/11. All revenue from the day goes to charity. The glitz of Charity Day, though, was born out of darkness. In 2001, Cantor Fitzgerald was based in the World Trade Center, and when the plane struck, the firm lost 658 employees, about 70% of its workforce at the time. CEO Howard Lutnick vowed to rebuild the firm. 17 years later, he says it's quadruple the size.
This is the way each of them gives of themselves. They're part of Cantor Fitzgerald. They remember those 658 people. Each of these people behind us, they're waiving their days pay today. They're asking all their clients to do as much business as possible. And we give away not our profits, every penny of revenue we give to about 150 different charities to try to turn the toughest day into something really beautiful.
Lutnick, who lost his brother in the attacks, was taking his son to school when the towers fell, which is how he survived. Tony Blair was Prime Minister of the United Kingdom during 9/11 and gave the now famous shoulder-to-shoulder speech where he pledged to closely ally with the U.S. in its time of crisis.
The relationship, is sort of ebbs and flows somewhat, but at its roots, it remains very strong, and it always should remain strong, because in a world that's changing fast, the values that define the United States and the values that define Britain, and a basic belief in freedom and in democracy, I mean, these are important things in the 21st century to stand up for. So I hope we never suffer a traumatic event again like 9/11.
Blair's trading revenue from today will go to his namesake charity, which works on projects in the poorest areas of Africa. Steve Buscemi volunteered as a firefighter following 9/11, working 12-hour shifts to rescue victims from the rubble.
Well, I used to be a firefighter in Engine 55 in the early 80s, and on September 12th, I went down to my old firehouse, Engine 55, and then I went to the site with them and was down there for about a week.
Proceeds of Buscemi's trades will go to Friends of Firefighters, which provides counseling and other services for firefighters and their families.
Over the last 16 years, Cantor Fitzgerald has raised almost $150 million for charity. At the very least, it makes this very tragic anniversary just a little bit easier, knowing that they're doing something for good. For Nightly Business Report, I'm Leslie Picker, New York.
Here's another look at the numbers on Wall Street today. The Dow advanced 113 points, the Nasdaq up 48, and the S&P 500 added 10. It's great to have you back.
Great to be back.
That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening, everybody. We'll see you tomorrow.